Welcome to Stocks in Translation. I'm your host, Jared Blikre. Alongside me is the people's voice, Sydney Freed. First, before we start, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Caleb Silver. He is the editor-in-chief of Investopedia. And this is your third time, so welcome back here. We just got a new president, and today we are going to focus on what to expect in this year, 2025. Our phrase of the day is policy uncertainty. We say that the market hates it, but what can we learn from the unknown and the unknowable? And this episode is brought to you by the number 4.5%. That is Caleb's magic number for the 10-year yield, why the bond market rules the world and the stock market along with it. And so before we dig into things, Caleb, just give us your big picture overview of what you think of the market action so far in 2025.
Yeah, aggressive. People are optimistic, and you never know which sector is going to rally. It really depends on the proximity to power right now. The closest you are to power, the closest you are to the president, the more you're going to see a rally in your sector. We've seen it with AI already. We've seen it in the conversations around more drilling, drill baby drill. We've seen it across different sectors, obviously in crypto as well. So if you're close and you're in that inner circle right now, the sector is rallying, but the overall market is rallying. We got a lot of enthusiasm. Sentiment is very positive right now. The question is, what's on the other side of this positive sentiment?
Yes, and so let's get to that because this is perfect. Our phrase of the day is policy uncertainty. And that, let me define it real quickly. Policy uncertainty is the unpredictability of government actions like taxes, regulations, or trade rules that can impact business decisions, economic growth, and investor confidence in markets. So we think about what gets the bulls and bears going a lot of the time, you know, the unknown, the unknown, the unknowable. And where does policy uncertainty fit in? Where does that get you as an investor thinking like that?
Well, if you think too much about it, you're missing a very good rally right now, and you're missing it across a lot of sectors. So if you get too muddled up in what's going to happen, you're going to miss the action, and the action has been very intense across investors' favorite parts of the market traditionally. We've seen the AI stocks rally back aggressively. We've seen the FANG stocks rally back aggressively from a lot of that choppiness we saw at the end of December. So that's where a lot of it is. The uncertainty is really around tariffs and around taxes. We kind of have an idea about taxes. The 2017 tax cuts are likely to get extended, and the corporate tax rate is likely to come down. Good news for the bottom lines for companies, which is good news for investors. Tariffs are uncertain, but we know that is the stick in the conversation with the Trump administration and countries like Canada, Mexico, and China. If we don't get what we want, we will use tariffs. Tariffs are inflationary by nature, and you've seen a lot of companies scrambling already to think about how they might deal with tariffs, especially the automakers get a lot of autos, a lot of trucks, and a lot of auto parts from Canada and Mexico.
Policy uncertainty, to me, it feels like it's like a quick reaction, like hours or days. It's like, oh, someone like President Trump makes one announcement, people freak out for 2 hours, and then it kind of unwinds later.
That's how we're conditioned.
Yeah, so I don't get, is there like a longer term implication for policy uncertainty in markets, or is it really a short term issue?
Well, this president does not hold back. He lets you know what he's thinking, even if he's not going to do it. So versus President Biden, who really didn't talk that much. We've already seen 2 or 3 press conferences with President Trump, and we're just a few days into the presidency. He lets you know even if it doesn't happen. So investors are left scrambling, wondering which sector is going to rally next or who is this going to hurt. In general, though, investors can look at this landscape and say, this president and this administration is coming into office without a recession, with a growing economy, pretty healthy unemployment rate. It's only 4.1%, plenty of jobs out there. Consumers are spending, they're confident. It's rare for a president to come into office in the last 20 years and not have some economic crisis or a recession. So wind at their backs, which means more growth. And now we know that this administration is very favorable to business, very favorable to cutting regulation. All of those are good signs for corporate profits, which is why we're here.
You just said something really interesting. I'm thinking back to George W. Bush. He walked in to the dot-com bust, and then we had 9/11 shortly after that. Obama came in right in the middle, at the beginning almost, of the global financial crisis. And then, 2020, Biden came in the beginning of the pandemic. And you're right, there is this kind of runway. I'm thinking in terms of companies. We're at the beginning of earnings season right now, and you mentioned the favorable tax rate. Just what do you think in terms of corporate America? What are the CEOs thinking of right now?
Yeah, those that have to deal with a lot of imports or selling their goods overseas where tariffs could be a factor are scrambling right now. We've heard about all these war rooms being set up inside corporations, but in general, companies are thinking about the fact, if you take the financial sector just for one, there's going to be less regulation. There's going to be a lot more deal making. There's going to be a lot more risk on the table, which is good opportunity for them to make money throughout their brokerages businesses, throughout their investment banking businesses. That's positive for the banking sector, and you need the banking sector to have the wind in its sails for the rest of the economy to move along healthily. Look at the AI sector. Look at the size of the investments announced in just the past few days and what's coming down the pipe. And we know this country and the administration is firmly grounded in the fact that they want to lead the AI revolution. A lot more spending in that area, which is good for chip makers that are making their chips and selling them in this country, and it's good for the companies that are operating in this country looking to expand their AI footprint, and we know just about every company wants to do that. So you kind of have the wind in your backs if you are a company in one of those sectors right now. Big mysteries are healthcare. What's going to happen there? We're going to have healthcare policy. We know that Trump tried to undo Obamacare when he was first in office. What's going to happen with healthcare policy? What's going to happen with insurance? That's a big bogey. And climate, of course, is not, nobody's talking about that right now, but we were just a couple of weeks ago because I think it's the biggest risk on the table. Climate risk is the biggest bogey out there because you just can't plan for it.
And how does that fit into, I'm looking at your notes here, you're talking about the unraveling of the insurance industry. That's a pretty big statement, affects a lot of companies, and we don't necessarily think about them because they're involved in safety. They're supposed to do boring things, but we're talking about trillions of dollars. What do you mean by this?
Well, I mean, if you can't get insurance on your home, yet you need a 30-year mortgage to be able to finance your home, and you can't get the mortgage without insurance, how is that going to work in the nation's biggest states? I'm talking about California and Florida, but I might as well be talking about New Mexico, where I'm from, wildfires there throughout the summer and the early fall. Wherever you live, it's harder and harder to get insurance. And if the insurance is not going to pay out the claim for what you thought you were insured for, why would you get it in the first place? And if you can't get the mortgage without one, we are at an impasse here with this industry. You see it in the housing industry. You also see it in the healthcare industry. And we've seen what that looks like when it gets really, really dark. So the insurance industry needs to be rethought about, especially in the era of climate change. And if we're going to drill, baby, drill, that means more climate disaster is heading our way. Nobody wants to talk about it, but that's kind of what's coming.
So it sounds like government intervention here. In theory, insurance companies are supposed to pool risk. You're supposed to take a global or maybe a large, you're supposed to cast a wide net, and then if something happens, you've got everybody else kind of footing the bill for those people over there who have a problem right now. But we're seeing these problems cluster, and so that's presenting a very difficult situation for the insurance companies. And like you said, they're dropping policies. So how do you incentivize them? How do you incentivize them to reintroduce these policies and the availability?
Well, what have they been doing? Raising rates and raising premiums. We've had inflation across pretty much every part of everything you touch as a consumer, but insurance inflation has been extraordinary over the last 4 to 5 years. So they've been raising premiums to do that. And guess what? We pay our insurance every month. If we're a homeowner, if we're a car owner, if we have life insurance, we just pay it automatically, which is why Warren Buffett's one of the richest people in the world. That said, if you're not going to get paid out when you need that money, you're going to find it harder and harder to sell insurance. It's hard on the insurance companies themselves. It's hard on the reinsurance companies, the Swiss Re's, the Berkshire Re's of the world, the General Re's that have to back these companies when major catastrophes occur. We're having major catastrophes every single year. Last year was one of the worst. 2023 was no picnic either.
And I want to bring it to the markets and this sector rotation that you noted, green to black in energy. How do you see that playing out in the market?
You see it with the wind turbine manufacturers, solar manufacturers. You've seen this shift from the Inflation Reduction Act tailwind that they had once that was passed, which was really a green energy bill in disguise, now to drill, baby, drill. You're seeing the drillers do very well in this environment. You're seeing the oil majors do very well in this environment, and the services that support the drilling industry are doing very well now as well. So you're seeing investors pull out of, if they haven't already, green sectors and move them into oil and gas and the fossil fuel sector.
I just want to bring up a fact that I've bounced off a few other guests. If we think back to Trump 1, all the predictions in the beginning, a lot of them were just misplaced. They didn't come to pass. It's very difficult to say, okay, we have a new president, but 4 years out, here's what's going to do well over the next 4 years. Investing is not that easy. Traditional energy did not do well under Trump 1, but green energy did, actually. You can see that in the solar ETFs and a couple other examples, maybe even wind. What do you think? What's your horizon for these thoughts? Is there any investment implications, and how long can you project them to be relevant?
Well, the fact that he's undone a lot of the Inflation Reduction Act laws, including the green energy credits and the tax credits, means you're just not going to be incentivized as a consumer or a small business owner to buy a fleet of green vans, so to speak. That's going to be rough on that industry in general. What's different about it this time, and we never say that investing, but you have to, this time, is that Trump has the backing of the House and the Senate, right? There's a lot he can do, having a complete Republican Party behind him every which way he looks, plus the support of the courts. So he can pass a lot more than he could have. There's going to be court challenges, but the courts are kind of stacked as well. So I think he has a lot more runway to pass a lot of the policy that he's been outlining since he was back on the campaign trail.
And bringing this back to your proximity to power comment, so can you elaborate? Does this mean like if a CEO from like a utility company cozies up to Trump, that, you know, utilities are going to break out? Is that basically what you're saying?
Well, if you look at the inauguration and the seating chart of the inauguration, it gives you a pretty good idea of which sectors and which companies got the prime spots.
We got a who wore it better that's going to take advantage of those very facts. So yes.
Absolutely. So a seating chart makes a lot of difference. If you were visited to Mar-a-Lago before the inauguration, maybe you have a good chance. But still, this is about policy in general. It's not about necessarily favoritism, but you have to be close to this administration if you want to get things done. And that's why you've seen the tech CEOs cozy up to the Trump administration as we got into the inauguration and beyond. That's going to continue. That's where the investment is going to be. The country is going to be heavily invested in onshoring, right? In nationalizing all parts of the economy so that everything is made in America and bought in America. That's very good if you do business here. Half of the S&P 500, though, gets its revenue outside of the U.S., and you have a really strong dollar like the one we have, that could be very challenging for them. So it's going to be a dance between tariffs, the threat of tariffs, a strong dollar, and whether or not you're doing business here in the United States of America. If you're a chip maker based here, we know there's a lot of money going into the support of chips, and there's a lot of money going towards the support of the development of AI plus crypto.
Is there anything in the markets that have surprised you this year so far, kind of Trump related?
Yeah, I mean,
3 weeks in.
3 weeks in?
Yeah, 3 weeks in, I'm not surprised by much, except the fact that we had such a good 2 years in the stock market. And if you just stayed invested, you've done very well. Usually don't get 3 years in a row like that, but there's a lot of enthusiasm now with the incoming administration where everybody's kind of bullish right now. When sentiment is this strong, everyone's leaning to this side of the boat. You know, at some point, there is a reversion to the mean. And it's not because of something the administration did. It's just the way markets work. And you see it here on the floor of the stock exchange every day. More buyers than sellers one day, more sellers than buyers. We're going to revert to the mean eventually. And this enthusiasm will be curbed, but we have to have a lot more detail in terms of policy in some areas.
Fear and greed. Hold that thought. We need to take a short break. Coming up, we're going to be divining the bond market's critical number that could make or break the risk rally this year. Plus, we've got a special inauguration edition of Who Wore It Better Today. We are back, and this episode is brought to you by the number 4.5%. Our markets guests, they have tended to make these make-or-break numbers for interest rates, and this is Caleb's threshold here for the U.S. 10-year yield. So below 4.5% is the, quote, green light for stocks, you're saying here, and I'd note that we're currently higher than that. We got the 10-year at about 4.6% today, and we've got the S&P 500 knocking on record highs today. So we're just a little bit above, but you say if we dip below 4.5%, it's off to the races.
It's green lights, and that's just the equity risk premium at play, which is what big investors are thinking about all the time.
And break that down real quickly.
The equity risk premium, how much you stand to gain in looking at a sort of a neutral investment to base it off, and that would be the 10-year yield. So how much more gains you could get in the equity market if bonds are at a neutral rate. Bonds are not at a neutral rate right now, but big investors are constantly thinking about that exchange here. If the equity risk premium is low, that's risk on for the stock market. When bond yields rise, the equity risk premium, it's a little bit higher, and you got to make a decision as an investor. Should I stick it out in bonds here, where I know there's safety and I'm guaranteed to get paid back, or am I willing to take a little bit more risk, equity risk, and buy stocks to try to capture some higher alpha? So that 4.5% number is key. Yes, it can drift a little bit higher and stocks could go up. We saw that happen a lot in 2024. But every time it drifts higher, 4.6, 4.7%, you see major sell-offs in the stock market because investors are just making that simple choice. And sometimes it's the algorithm, and sometimes it's an active investor saying, that's a little too high on bond yields. I better pare back my equity risk here. So that's what we're seeing at play.
And the speed of the move, too. It seems like the knock to the risk markets tends to happen when you've got bond volatility just kind of skyrocketing. I want to ask you about the Fed, because the Fed is closely tied to interest rates. We've been talking about the long end, but I want to talk about the short end now. Do we need any rate cuts this year, and have we had too many already?
We went into the year thinking we'd have 4 or 5 cuts. We might see the terminal rate for interest rates come down. That's the final rate at which the Fed finally stops raising or lowering rates. That terminal rate thought it looked a little bit more like 3.5% going into the year. Right now, it kind of looks at 4%.
Yeah, 3.95%.
We're at 4.25%, 4.5% right now in the Fed funds rate. I don't know if it's going to go much lower. And the problem with cutting rates at a time when the economy is kind of humming right now, and there's a lot of government money being poured onto sectors, is it does induce inflation. And that's what the Fed has been spending the last couple of years trying to knock down, inflation. Yes. They got us to a point where inflation is growing slowly. We don't have disinflation, right? We don't have deflation. We don't want those things. That's a sign of a troubled economy. And we don't want stagflation, where prices are rising, the economy is slowing. The economy is moving along nice, and inflation's at 2.5%, 3% right now. So another cut might just be octane that the stock market doesn't need and the economy doesn't need right now. So I think they might hold at the next meeting. But if they hold too long and interest rates stay too high for the president's taste, anything can happen in terms of the future of the Fed. We know Jerome Powell is supposed to be in office until May of 2026. That is a very long time from now.
How should investors think about the Fed holding? So if interest rates are going to stay higher for longer, what are the considerations?
Well, interest rates have been high and the stock market's done very well. Why has that happened? Well, part of the fact is that corporate profits are growing, and they're growing in some of the biggest, strongest companies out there that are part of the AI revolution. So corporate profits can go a long way to mitigating high interest rates. The other thing investors should think about is rates were high, stock market went up, but you also got a lot of money in the bank, right? You have alternatives. We went through a long period of time called TINA where there was no alternative. There is no alternative.
The teens, yes.
There are plenty of alternatives right now. So as an investor, as a saver, as somebody who's trying to maybe save for the long term while investing and generating some alpha in their portfolio, you can do both. You can have it all right now. So don't be so quick to want interest rates to fall unless you're trying to buy or sell your home.
Caleb Silver says you can have it all right now. That's the headline.
Let's get to, I want to get back to risk management, and that kind of involves more market stuff. But you mentioned before that we're in a really good spot in the risk markets. And for the record, like the S&P 500 has just been screaming. It almost seems like even on the bad news days, we don't get that much of a drop here. But things change. And so what are some of the signals that you'll be looking for maybe in different markets that say, okay, we've had a nice run, but it's time to pull things back a little bit?
Yeah, I'm old school, so I'm going to look at a lot of the old school indicators. I love the Dow transport theory.
Yes,
right? That's age old, and I look at transports. Now, I don't look necessarily at railroads, although we're big railroad fans. Think about the transports of the 21st century.
They perked up, though.
The FedExes, they perk up. If the transports are rallying, the industrials are rallying, I feel pretty good about the rest of the market. If the banks are rallying and we're getting bank earnings this week and next, we're going to get a lot of information from the banks. If their net interest margins are strong because those lower rates have actually helped them, then I think that's a great sign. Financials, transports, industrials, they're the backbone here. We know the Mag 7, we know the high-flying A stocks get all the attention, but you need a good bench scoring, as we say in basketball. You want everybody to be in double figures and lots of assists out there to have a really strong, robust bull market that can run on for a couple more years. But right now, you have good profits, right? You have a deregulatory environment. You have a government that really wants the stock market to do well. They use it as a scorecard. And you have a lot of money being poured into the economy right now. Those are all good signs for corporate profits, good signs for investors. Sentiment can change on a dime. We know that. But lately, those dips have been bought up very quickly, right? We have not had a correction of 10% in quite a while. We're due, but we're always due. The fact is, every time we get them, they seem to be bought up rather quickly. So I'm not that worried about that. Stay invested, stay in it for the long term. You've done very well if you've listened to that advice.
All right, today's Who Worked Better is a little bit abstract, so stick with me here. Monday's inauguration wasn't just about politics. It was the ultimate runway for influence. Now, we saw Elon Musk, as expected, but front and center with President Trump were Mark Zuckerberg and also Jeff Bezos at various times. And sticking with our runway metaphor, we'll call this the contestant, the proximity to power, because that's a phrase that you've been talking about here. So on the other side, we've got the financial statements of the company. These titans happen to have launched. We got Amazon and Meta. And here's the question: which contestant matters more to the shareholders of these companies? Is it the proximity to power that's ruling the year, or does sales growth, profit margins, and PE ratios, do those matter more?
I'm going to go for the power seat right now. You want to be close to the president, close to the administration, close to the Commerce Department and the Treasury, close to the SEC, which is creating new rules around the crypto sector right now. You want to be close to Washington. That's why everybody's moving closer and closer towards the White House right now. Then I think we'll get back to fundamentals. fundamentals, investors will really start looking about things that actually matter. But right now it's about power. It's about every news conference and the latest initiative or the latest executive action. That's driving the market. That's driving a lot of market activity right now. We'll get through this, but this is where we are in the first few days of the administration.
Well, let me ask you, because expectations for the so-called Mag 7 are riding pretty high here. What if the financials, the fundamentals don't necessarily line up? In other words, they're still having high growth, but not as high growth as expected. Do you think the power nexus kind of overcomes that?
Yeah, probably in the near term, because investors want to be around these stocks. They've been delivering the returns over the last few years and probably will continue to do so. But I think 2025 is the year where you have to prove it, especially in the AI investment. We know the biggest companies in the world have been spending billions of dollars because it's an all or nothing game when it comes to AI. This is the year we want to see robust profit margins because of those productivity gains. We want to see the investment in AI paying off in wider margins, better profits, and that will drive stock growth. And I think investors are going to be patient with that for a bit, and then they might lose their patience because they've done very well over the past few years, and it's hard to come up with 100% profit gains like NVIDIA's done for several years in a row.
I have a proximity to power question, but more about like people like these tech CEOs. Isn't it like the higher you climb, the faster you fall? Aren't there a lot of risks also for people who get really close to the administration?
100%, and especially with this administration, because we know relationships come and go very quickly, but that happens all the time in Washington. This is the little Potomac two-step, as they say, in Washington, where you get in with your lobbying groups and you get into the administration and you get some deals done. That said, you can get too close and things can change very quickly. We're going to be watching very closely these relationships. Elon Musk, Jeff Bezos, the OpenAI CEO. We're going to watch how these relationships develop over time. But right now, that proximity has been very good in terms of the investments that the government has already announced, and we're just a few days into this administration.
Stepping away from the mega cap tech companies, I want to turn to small caps.
Oh, brand new for this conversation.
Exactly. What are we thinking there? Is it finally time to break out?
Yeah, I mean, small caps are very sensitive to interest rates, right? They borrow a lot of money. Their debt to income ratios are usually pretty high because they're small and they're trying to get bigger. But if you're in the right sector, you've gone from micro cap to mid cap like that, especially the quantum AI stocks. These were tiny companies. They were barely penny stocks just a year ago, and now they're some of the biggest companies in the stock market. So if you're in the right sector, you're not going to be a small cap for long, but it's really an interest rate question. So if rates stay high, they're going to be under pressure. And if they do a lot of business outside the US and we have a strong dollar and a tariff war going on, it's going to be very rough for small to mid-sized companies to do well. Right now, big is beautiful, and that's kind of the way it's been for the last couple of years, but right now it's especially pronounced.
It's time for us to go. Be sure to check out all our episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, but we will see you next time on Stocks in Translation.